Hello and welcome to the Wealth on Purpose podcast. It's here where you can navigate the important financial topics that you want to know about, designed with convenience in mind and a human tone of voice, communicated to you through real stories and a wealth of experience. This is Wealth on Purpose with Brian Diffily and Brian Hartmann.
Welcome back to the podcast, Wealth on Purpose. So glad we're back in the studio here. We have it's really not a lovely day. I was going to say it's a lovely day, but the weather's a little bit icky, but I don't care. We're inside. Doesn't matter.
It's a perfect vest day.
We're all wearing our vests. And I mean, I wasn't wearing one, but I am now because I felt insecure about these two masculine men to my left. So I'm throwing on a vest, but now I think we all look more uniform and ready to go podcast it up, right? We have a very special guest with the podcast today. We have Cody Ward with us, Bri.
It's pretty big deal, Cody. I don't know if you know this, but this is the #1 financial podcast in the world, according to us.
According to us. So
wow.
that's
I'm honored to be here.
Dad joke checked 1. There's going to be a few more ready to go, but that is true. So Cody Ward. So Cody, why are you here? We're very lucky to have you here. You are a mortgage loan officer. You're very, very busy gentleman with CMG Home Loans based in Charleston, and we've known you for a little bit now, Cody. And what I really appreciate about you is you are a truth seeker, but you are a teacher in a lot of ways. I mean, you really do get into the nuances of your business, and I really appreciate that. I mean, as financial planners, certainly we appreciate that, but just as people, I like that you really go the extra step and really go through the whole field of things, treating the mortgage as a real holistic process. So I think that is your differentiator, one of many. So you get clients loan ready. So we're going to get into a bunch of things and stuff surrounding all that. But anyway, welcome to the podcast, man.
Thank you very
for being
much.
Here.
Appreciate you having me.
So we have, a few bullet points that we want to get into, but I mean, tell us a little bit about yourself first. Like, what got you sort of lit up about this industry? How did you get into it, and what keeps you lit up about it? Because every time I talk to you about it, I'm like, God, this guy's on fire with this stuff.
Yeah. So first of all, thank you for having me. It's #1 podcast in my heart.
Appreciate that.
As I haven't always been in the mortgage industry. I worked a lot in Silicon Valley tech startup world, originally from California. But I've always had sort of a tangential interest in real estate. My family was in the business, grandparents. So we've always sort of had this interest. And as I was looking at sort of what the next step is, as my family was growing, what could I do? I've always wanted to, for lack of a better way of saying it, make an impact on the world.
Yeah.
And I feel like in this business, I can help impact individuals' worlds by helping them buy homes. But I just felt like there was such an opportunity in this business to do it differently, having bought and sold homes before I was here. And so to be able to kind of bring this service level, excuse me, this relationship aspect to the business. And luckily for me, I found mentors, coaches and things like that feel the same way. So I'm really excited. What keeps me going and what gets me excited is that there are so many opportunities for people. There's a lot of data and studies that show that homeownership really leads to generational wealth.
Yes, sir.
And it's a big part of that. And so being able to kind of help people make that first step or continue that step towards, improving their family and their next generation is extremely exciting for me.
And not make missteps, right? I mean, try to avoid some missteps or at least walk around them. That's amazing. So let's get into it. I mean, one of the biggest drivers in your industry, I imagine, what's surrounding a lot of the narrative that you're talking about your clients with, and even if you weren't in this industry, people are paying attention to rates for a number of different reasons, right? Loans aside, but I mean, loans is what impacts your clients. There's been a lot in the headlines about that recently with the Fed. Where, what are you talking about, or how are you talking to your clients about rates, and how are you positioning that? If clients come in a little bit gun shy to the table, or what are some concerns, and then what are some things that are maybe just the things that they don't need to be concerned about when they talk to you?
Yeah, it's a good question. So obviously right now, and when we're recording this, the Fed has just cut rate here. And so that's the big headline, right? That's the big news right now. What we're actually seeing, is leading up to that cut. The mortgage rates were actually a little lower than they are now after that cut. And the big thing that, some people don't realize, or maybe do, but aren't really sure, is the Fed is not cutting mortgage rates, right? The Fed does not control mortgage rates. Mortgage rates are based more on long-term yields and investor sentiment. And really the better place to look for a mortgage rate is more in economic factors than it is what the Fed's doing. Now, does the Fed cutting rates portend, potentially rates coming down? Yes, right? Like that is good news, right? From from a long-term perspective. But really the reason why we saw rates that were lower before the Fed cut is words matter from what the Fed says. And so the market was basically, for the month leading up to the cut, already pricing in that cut was going to take place. And so really what matters now is, what are the future of cuts, right? They're more looking ahead at that. And so Powell's comments after the Fed announced that they were cutting the rates sort of made the market a little less excited,
right?
A little less anticipatory of future cuts. And so that's why we're seeing rates kind of, I don't want to say tick up, but like kind of remain flat even after the cut. So that's the big conversation that we're having. I think personally, my opinion is that perception matters a lot more sometimes than reality. I know, Brian, we've talked about this separately as well, is that just the news of a rate cut, is probably positive for the industry overall. For those who are, looking to buy or thinking to buy it, it's good news for, the future. That doesn't mean that, today, right now, the rates are the best they've ever been. Right. So that's the conversation that I'm having, really mostly around rates, with sort of the immediate news.
And one of the things that we pay a lot of attention to, because while we don't lend a lot of money to people for mortgages and things like that, paying attention to affordability really matters, right? Especially for, really not just first-time homeowners, but anybody. It could be you buying your second, third, fourth home, whatever it may be. Affordability matters. And what we try to remind our clients is, remember, if this is going to be a 30-year mortgage or a 15-year mortgage, that there's probably going to be opportune to refinance that along the way. So while your rate may be what it is at the beginning of your mortgage, if we are entering a period of extended declining interest rates, there may be a future opportunity. Waiting for that opportunity may make sense, but also just buying today with that idea that I can reduce this payment going in the future if you are very sensitive to your monthly payment on your mortgage, that probably is going to present itself sometime in the future. Trying to time that is probably more difficult than just understanding that will probably present itself in the future. So we try to talk to our clients about that too, is, hey, that's today's rate. We could play the rate game if we really want to, but if we are holding this for the period that you were intended to, there's probably going to be an opportunity to refinance this to bring the cost down. Do you have those conversations?
Yeah, it's a great point. I think I've heard both of you say this, right? And it's a pretty common term. It's not about timing the market. It's about your time in the market, right? And so, the what we've seen historically, and this happens, basically, I think it's something like over the last 80 years, it's like 75 of them have seen home ownership or home values appreciate. So it's more about, getting in on that investment and treating the home as that investment. From a rate perspective, yes, the timing of it is, if the house is available and you love the house and you can really stomach the payment, we are in a period where rates are going to continue to come down. We anticipate, right? I don't have a crystal ball, or else I wouldn't be sitting here with you. I would be on my plane to fly to my private island. But the key is that, like, fall in love with the house, because most of my clients, I tell them, like, the mortgage you have today is probably not the one you're going to have in 12 months, right? And I think that also goes to another point is, is paying points, right? Buying down the rate, right? If you are not going to stay in that mortgage for a long time, it really doesn't make sense to spend money on buying down that rate. Again, rate buy downs are a great tool, but you really have to kind of do like an ROI calculation. But yes, to your point, get the house now, because as rates come down, what happens and what we see, right, is that rates come down, the buyer pool gets larger, competition increases. If you bought a house in 2020, 2021, when rates were really low,
right,
there were dozens of offers on the same house and you were losing out on those because everybody could buy a house, right? And then what we saw was prices go way up. Selfishly, I took advantage of that. I sold a house during that time and took advantage of a lot of appreciation because the market was paying a lot of money for that, right? And so what we anticipate will happen again is, right, as rates come down, buyers come in, competition increases, and whether list prices go up, it's more about like the amount of offers that could drive up prices go up, right? And so when people would call me and say, well, I'm worried about overpaying, right? With the rate, I'm worried about overpaying. I would say a lot of times, the only way you're really going to overpay is if you wait for rates to come down and then you have to bid artificially high on that house because you're competing with a bunch of other people, right? Buy the house at today's price, change your payment and your rate later, but the price of the house will always stay the same when you bought it. But if you wait, then you're competing. You may have let's call it, again, not quoting rates, let's say a 6% versus 6.5%, but you had to pay $50,000 to $100,000 more for that house. You're really not saving any money or that much money on a monthly pament, especially when you think about the increase in value from a property tax perspective and all that stuff. So the timing aspect of it, you're never going to time the market, and there's no crystal ball. There's no way to see what's going to happen. It's more like I say, talk to someone who can break the numbers down. We say this all the time. Let's put the numbers into really sharp focus so that you can understand what your budget looks like, what you can afford, what is comfortable, and then go make a decision based off what's comfortable. And if it's not comfortable now for the house that you want, then maybe it is a wait and see what happens, right? But if it's comfortable, you see the house, it's right for you, it's right for your family, the time is right, you're making a decision that's good for your, short-term and long-term future. Like there's no reason to try and see what the market's going to do. Just you can really jump at that.
Yeah, because if you're waiting to see, to your point, if you're waiting to see what the market's going to do with the position of where rates are most likely to be projected to go, they may be in a harder situation to get. I mean, the competition is going to be
correct,
insane.
Yep.
But you're able to, that's crazy. So, and then so you're talking a little bit about strategies for a market that's not overpriced, but let's just say higher price market, which, this area certainly is. I mean, nationally, there's a tremendous amount of pockets where there's high price markets, certainly here in Charleston, in Mount Pleasant, especially too, right? I mean, so how are you able to talk to people about that, in terms of positioning themselves? Is it as simple as, not as simple, but is it just getting people into the office, crunching the numbers, so to speak, and just, laying it all out there in that, sort of like teacher perspective that you have?
Yeah. So I tell everybody, plan, right? Like it is never too early to make a plan. And the line that people in my office probably are tired of hearing me say is, you can't stick to a plan that doesn't exist, right? And so if you're not planning for what the future or what the purchase looks like, you're going to be, probably more disadvantaged when it comes to shopping and finding opportunities. And so, the big difference that I like to talk about, especially when shopping in markets like Charleston or high price markets, is go through the process and figure out what those numbers look like. Talk to a lender and figure out what is the range of what I really want to be comfortable with spending and what is the price point that matches up with that. With the understanding that hey, going back to our previous conversation, if rates were to come down, that just gets more comfortable, not less comfortable, right? And then the other thing is a lot of people spend a lot of time looking at their credit scores on the apps, right? On, I'm not going to name them, but everybody's bank app or whatever provides you with a score. Right. A lot of times those are what's called Vantage scores, which is a different model than what the mortgage score, or the FICO scores that are used are. They're just viewed differently. They're calculated differently. And so what I say is, start having those conversations earlier, figure out what the credit is, because if there's opportunities to improve your credit, and it's more than just housing, right? Improving your credit is going to improve your life drastically, right? Your credit card rates are going to get less. Your auto loan rates are going to get less. Getting money is going to be easier the better your credit is. But also your rate's going to be lower on your mortgage. So improving your credit, figuring out what those opportunities is key. And it's really hard to get your credit score up in 30 days, right? If you find a house and then you were like, I love this house, I would put an offer in, I'm closing in 30 days, but my credit score is low, it's really hard to get it up in a short amount of time, right? So planning ahead and saying, okay, we want to start shopping in the next 6, 12, whatever months it looks like, figure out what that looks like, figure out what the opportunities are to improve that score. Even if it's hey, I'm 720, I know I'm great, but there's opportunities to get to a 780, 800, right? That's just going to still improve your affordability, improve your rate and things like that. So starting that conversation early is big. The other thing I say is, and one thing we do, which I do for all my clients, is what we do is called fully underwritten pre-approvals, right? So, a lot of people will say, you fill out the form, the application online. It's a quick look at your numbers, quick calculation, like, yes, you're good. Now, that is all fine, right? But what we do is spend a lot of time on doing that planning and doing what's called a fully underwritten pre-approval. So what I do is I'll take my clients and I'll send them through the underwriting process with basically everything but a property, right? And so it's like, we're going to pre-approve you. We're going to confirm your income, confirm your assets, confirm everything like that, so that when you go to make an offer, the only thing that really matters is if the property passes muster, right? Mm-hmm. Because underwriting's already looked at, checked the boxes. We already know what we need. We've already collected all the documents. 2 reasons. One, you become that much more competitive in your offer because you can have a really short financing contingency, or reduce contingencies. You can close quickly because you've already done the heavy lifting up front. And you can, I say this is almost as good as cash offer because you know that it's not going to fall through from a financing perspective. That doesn't mean that the house is going to appraise or anything like that, but you've done that homework up ahead of time. Yeah. And that wins in competitive markets.
Well, I mean, it's slower to start probably, but it's faster to finish.
For sure.
And I mean, people need to finish fast. In some instances, it's imperative, right? So yeah.
That's what sellers are looking for that, and they want certainty. And so that's really, really important. And I think this goes to, from a plan perspective, something I see a lot, especially in markets like this, like Charleston, is self-employed borrowers. Right. I say this all the time. You can't have it both ways. You can't tell the government that you're writing everything off and you don't make any money, and then come to us and tell us that you make all this money. Right. Now, there are loans and there are programs that can get around this, whether it's bank statement loans where you look at, what's coming into a statement as opposed to income. But again, those are going to cost more. The rates are going to be a little bit higher for those usually. But the big thing is that if you're looking to buy a house, you're self-employed, you're looking to buy a house in the next 12, 18, 24 months, is talking with your CPA, figuring out, say, okay, I need to be able to document and show my income, right? And so, underwriters are going to be calculating income. We're going to be looking at that. So from a planning perspective is getting your ducks in a row. I really want to harp on this, self-employed borrowers is just making sure that not that your CPA is doing anything wrong because they're helping you not, pay as much in taxes. But again, you can't have it both ways. You can't write off a bunch of stuff and say you make $40,000 a year and then to the government and then come to us and say, no, I make $300,000 a year and I want to buy a house based off that, right? Because we have to go off what the documents show.
Cody, you are talking so much about what we see every single day from our clients. We're seeing people that are buying houses for different reasons than they ever had before, or at different times in their life. So we're going through a time that we think we're going to reflect back on as the great reallocation or relocation of America, right? We went through this as strongly, right, coming out of COVID, because as more and more people were doing their work from home, they said, forget it. I don't want to be where I have to be close to my employer. I want to be where I want to be and still be with my employer. And then we have a humongous aging population in America of people who are retiring that are saying, well, I want to be somewhere different for a climate, different for my lifestyle. And the last time that they applied for a mortgage, be it 20, 25 years ago, the process was way different. Their circumstances were way different. And maybe we're retired and we're no longer earning income, or we went from, to your point, from being employed by an employer to now being a self-employed person. All of that should be considered when you're going to apply for the mortgage. And the problem is solved by, I think, a simple thing that you said earlier: have a plan. Mm-hmm. We are in this process now of everybody's a realtor, right? Because we have Zillow on our phones and Redfin and Realtor.com. We can go and search markets and everybody's an expert in the markets. But what they forget to do is probably before we're going to look at homes, the 5-bedroom, the 6-bed, whatever we need, we should probably be talking about how our best ways to finance this. So that way, when we have, in my case, my wife and my kids touring the home, and as inevitably they always do is, that'll be my bedroom one day. And that's where the playroom will be. So then when we're meeting with our realtor or put in an offer, we actually know it's going to stick
Yep.
because it's such an incredibly emotional process. And I think these days, personal experiences and from those that our clients are sharing with us, it's pretty quick. You know, if you're going to be relocating somewhere else, it's not just down the street from your current home. Maybe you're only there for a day or two to go look at properties.
Yeah.
Maybe your realtor is showing you 15. You're like, okay, we need to make a decision this week because we're going to go fly back home and we need to get this done. Having your ducks in a row from a financial perspective and knowing what mortgage you're going to use, really the affordability of it takes out that stressful side of it.
Yep.
So when you're holding, your spouse's hand and have the kids around, you're looking back at that dream home that you're going to be moving into or your vacation property and go, yeah, we can do this.
Yep.
Right. And just taking that extra time. And I think because so many of us want to just get things done quickly that we think we start with the house, then call Cody. I think the reverse is actually true. Let's call Cody, to your point, get that real thorough pre-approval started. So when we are in the market, really looking at properties, we know we can get it done.
Yep.
Takes away that stress. And to Brian's point, probably makes closing a little bit faster and easier as well.
100%. And there is nothing more heartbreaking that I've seen for real is a family going and falling in love with a home.
Yeah.
And then finding out they can't actually pay for it. Right. It is hard. It's hard on the family, obviously. It's hard on the realtor, right? Because the realtor took time, their business, right? And they took time to show those 15 houses. But, if you don't know what you can afford, if you don't know, like you may think, oh yeah, we can, we have a $500,000 house now and we know we can buy $1 million house, but then the documents don't actually line up with that to a self-employed borrower example, or, it's a near retirement scenario. Without doing that planning, you're just in for heartbreak.
How many of the people that come to you, Cody, get surprised by that? Like, how many people get sidelined by like, oh my God, Vantage Score versus, on my ABC bank app, to your point, my score says this, and then you're like, well, then the reality sets in, or documents, to your point, don't match up. Does that happen
all the time?
Does it really?
All the time. Yeah. Which is, I think it's fantastic that those app scores exist, right? Like, it is fantastic that people can track their credit. They know what their, a general idea of what their credit score is. It's just different modeling. Now, I'll say this because, the future holds, some different changes in the modeling potentially. There's talks or movements to start moving to a different scoring model that's a bit more modern, if you will, for the mortgage. But what I will say is right now, yes, it happens all the time. And mortgage scores can move sometimes more wildly than app scores can, or just because they're calculated differently. An example that I talk about, right, is understanding again where your credit score is, but understanding like what goes into that is really important as well. Because sometimes people are like, I'm going to fix my credit, I'm going to pay everything down to zero, right? That sometimes hurts you, because if you pay everything down to zero or pay it off too quickly, your score is based off an algorithm, right? It's a math calculation. If the credit reporting bureaus see that you basically don't have any debt, right, that could actually hurt you, because there's no way to judge whether you're responsibly paying off debt, or you can make a regular monthly payment if you're carrying a zero balance all the time, right? I had a client where, their lease was up, so they got a new car. They bought a house, and so they had a mortgage, and both of those were within the last 8 months, right? They closed the credit card because they weren't using it, and they pay off their credit card habitually, right? And so basically what it looked like on their app score was they were fantastic, right? Like they had all the right things, they had everything like this. When we did the FICO score, it was like 60 points less. And the reason for that is, one, their credit age was really low because they had basically new accounts, and they pay off their credit card so well that the agency was basically seeing them like, this is a non-utilized card, so they have no revolving credit history, which is almost 30% of your score, right? And so there's ways obviously to look at that. You can chat with somebody and you can make a plan, right? It's honestly, it's as simple as carry a balance and let them see that, right? But if you're just looking at your app score without talking to a person that's looking at or checking your FICO score and again, doing this planning for buying a house, there's no way you would know that. And again, you end up in a situation where I'm looking at this house. I love this house. My family loves this house. I'm relocating. We found our dream home. And then it's, well, we actually don't qualify for that because we've paid off our debts too well. Right.
No, it makes so much sense. It's kind of like, going for a run and looking at the data on your Apple Watch, which I do, versus like a nuclear stress test, right? It's like, well, which, and you're stressing the heart out to, well, how do you know how efficient your heart is unless you go through these tests, right?
Yep.
So like, I mean, what you're saying makes perfect sense, especially when algorithms get involved.
Yes. Yeah.
Because they hold the torch on a lot of those things.
I will say, for everybody out there who's getting your credit score pulled, mortgage people, we're just the messenger. You don't have to get mad at us about your score. We're
People
just
throw stones at you?
Oh, sometimes.
You're giving so many good nuggets here today. I mean, one of the reasons why we love to do this podcast is just to make it easy, make it snackable for people, take something and carry it away with them. You are giving so many of these little nuggets away that are just fantastic. First home buyers, talk to us about that. What are some, how would you talk to a first time home buyer in this just environment? Define that any way you want to. What are some material ways that you would talk to someone if they say, Cody, listen, you know what you're doing. I want to buy a home in 12 to 18 months. What should I be doing to get ready for? Or how can I position myself in a competitive market? What should I do internally in the dark? What should I do in the forefront so people can see? How would you talk to someone like that?
Yeah, I mean, it's honestly pretty similar to what I would tell anybody, right? Is build a plan, right? Make that plan, figure out what the numbers look like, do that up front, because whether it's somebody who again has switched to self-employment and they're buying their third, fourth, fifth house, whatever it is, or it's a first-time home buyer, if you don't know what the actual numbers look like, what the math comes out to be, there's no way for you to know what to expect or how to build that plan.
That's fair.
But what I will say is first-time home buyers, one of the biggest myths that I see all the time, right, is people, one, they go, or I guess mistakes, I should say.
Run with that. Okay, I did. That's perfect.
The two biggest mistakes I think I see pretty regularly are, I need to pay off all of these debts for me to buy a house. Mm-hmm. And then they wipe out all their liquidity and they spend all their money to pay off the house. And they go, my credit's fixed. I don't have any debts. And then it's like, but you don't have any money to buy the house either, right? Like you don't have a down payment. You don't have closing costs, right? And so that's one of the big things that I see a lot of people is they're so focused on getting rid of all of their other liabilities and improving their credit that they spend every dollar that they have, right? And so one big thing that is part of that sort of planning process and getting loan ready, which we say a lot of times is how do we get you loan ready? We have great partners that we work with to do that, but it's not just paying off debts. It's paying off debts, making a budget, figuring out, where can money go? How can I save some? How can I pay off these debts? How do I work it down and to work towards a 12-month plan, right? Those are the kinds of things that first-time homebuyers need, should focus on too, is that buying a house costs money too out of pocket. It's not just like the monthly payment. There is costs. Now, there's programs out there to reduce those costs, to make them less. Sellers can help pay for closing costs in some instances. But there are always going to be things that cost money, right? The three of us have bought houses before. You buy a house, a month later, the water heater goes out, right? You
absolutely
always does.
Always does.
But something is going to happen, right? And it's going to cost money. And if you sunk all of your money into this house and you have no reserves, nothing, no liquidity, nothing to be able to back yourself up with a rainy day fund, that's a big mistake, right? There are going to be situations where you're like, I don't have cash. And then you're just going to lead into maybe you paid off all your debt to buy the house. But now you're going to have to go rack up debt to actually own the house, right? So that's a big one. The other one that I see, it's constant all the time, but 20% down, 20% down, 20% down, 20% down. I have to have 20% down. This is not the case, right? I believed that before I got into the industry. I was, scrounging to save every penny I could to get to 20% down. Now, yes, there are advantages to putting 20% down. You don't have to pay mortgage insurance, right? But a first-time home buyer in a conventional loan can put as little as 3% down, right? So if you are looking to say, hey, how do I get out of paying rent, right? I have some money saved up, right? And I want to buy a house, right? 3% down for a first-time home buyer. There are a lot of programs out there that can help reduce those costs where PMI is, obviously you're going to have to pay PMI mortgage insurance, but it doesn't mean that you can't buy, right? And so 3% down on conventional, 3.5% down on FHA. If you're not a first-time home buyer, it's 5% down on a conventional. And so you can put down you can still put down less than 20%. But it's just a matter, again, of doing that planning, figuring out what do we have to put towards the house, right? Not just how much money do we have in general, but and like, what can we put down, but what should we put down, right? Doing that planning of like, what do we need to set aside to make sure that we're comfortable after this purchase? Or maybe, hey, I'm buying this house, but I know I'm going to need a new roof, right?
Right.
I don't need to put 20% down and then live with a subpar roof, right?
Right.
I can put 10% down and go, replace that roof. So housing is available. There's also programs like a USDA loan, right? It's very location dependent, and there's a lot of rules, and we're not going to get into individual loans here. But a USDA loan, if it's right, it's a 0% down. You really are you don't have to put anything down. Now, that means you don't have a lot of equity in the house, right?
Mhm.
One. And two, like, your payment's obviously going to be higher than if you put less down because your loan's higher. But still, like, if you're looking and you want to make a move, talking to a mortgage person and figuring out, this is where I want to live, what are my options that are available, and that's why I tell a lot of people, like, I see this more as like strategy discussions, right? Like, what's the right strategy for me to buy a house? Because again, it is sinking every last dollar I have into this house is probably not a smart move. I imagine both of you would agree with that. But like, also, if I can put 20% down and still live comfortably, what does that look like relative to putting 25 or 15 or 10% down?
We see people come to us all the time and they'll say, oh, I found this great tool online. And I put in my income, and I put in my other debts, and it told me I can afford $1 billion home. Right? We're so excited. We never thought we could buy $1 billion home. And a lot of times we would say, well, what the tool didn't ask is, what else are you spending your money on? What else is important? Are you contributing to your other savings vehicles? Are you contributing to your 401ks? Are you saving for your kids and all those kinds of things? And they'll say, yeah, we are. Well, the tool online might not have accounted for that. It just says, hey, here's how much money you have. And if you put these basic numbers together, you can afford that $1 billion home. And you go, well, but we can't. Not if we're accounting for the other things that are also included for you. So you said it, and I wish we could underline it in this, but you said, call your person, like call the Cody. Right. So that we can talk about, hey, what else is important to you? What else are you guys really contributing to right now so we can get this number right for your family?
Yep.
So it's a holistic view of things. It's not as easy as, oh, I went online, found the calculator, threw my numbers in and told me I could afford this house. That could be true.
Yep.
But we want to make sure that we're accounting as prudent financial planners on our side, I almost want to call you like a mortgage navigator, right? Because that is much more than this. You are really helping these people find the best tool. That brings me up to a second question where we can probably bring this home. In today's mortgage world, it's not your mama's mortgage, right? There are a lot of new products that have come to market, and they don't necessarily always have headlines. There's not a whole lot of education behind these kind of things. That really is where you can step in and educate these people, because mortgage lending used to be pretty simple, right? There was a couple ways to do it. Now there's many, and they're much more accommodative for special scenarios where people are looking for additional liquidity options or future liquidity options. And a lot of these mortgages are built in. And a lot of these programs, at least to our knowledge, were widely available in other areas of the world. But now America is kind of like also using these systems too, just to help people solve their unique problems. So our advice always is to people that are making their financial decisions is keep an open mind, right? There might be a suggestion that your financial planner makes that you've never heard of that actually is really appropriate for your situation, that maybe wasn't advertised on the big billboard that you would drive on the highway. I think the same thing is true of the mortgage world. So staying open-minded to, I might actually be looking at an option that I've never heard of before. Do you see that?
I do. Yeah. And it's one thing that I love to talk about with my clients, right? Is figuring out, and I think I do want to take a step back here, because you mentioned it, and I know you both are in, the sort of advisor world. And so working hand in hand with the team, right? Is I always say, like, let's get the team together and figure out what this looks like, because a mortgage shouldn't just be a liability, right? That you just set it and forget it, pay it every month, right? A mortgage in a house can be a real financial tool, but it has to fit into the larger plan, right? And so, when you're talking to clients and it's, hey, what is our goals, long-term, short-term, everything like that, right? The mortgage, assuming they have one, or they want one, or they want to buy a house, like, should fit into that picture, as opposed to just being like, oh yeah, my mortgage is over here, but the rest of my money is over here, right? You are taking on what will likely be the largest debt you're ever going to take on in your life, and making one of the biggest purchases you'll ever make in your life. Yes, you're borrowing money to do it, but it's a huge purchase, and it shouldn't be something where your financial advisor is out on the side.
100%.
Right? And so having that kind of combined conversation, to your point, is fantastic. And then exploring those opportunities because there are a lot of things that have changed since 2008. One, there's a lot of things that are much more highly regulated. And so they're much safer than they used to be. There's a lot of things that have come out, into the light that, were not great practices. But a lot of that stuff has caused concern about anything other than like a standard traditional, 30-year, right? There's people that are like, I don't even want to touch an adjustable rate. And that's sort of like a little bit of a potentially like an old theory. Yes, there are some adjustable rate gotchas that you want to avoid. But there's tools that can help increase liquidity, increase access to equity that are available. And in any market, cash is king, right? And so keeping liquidity available as opposed to throwing it all into your house, which is inherently an illiquid asset for most people, right? It's like, if I have $1 million, I can just throw $1 million in a house and have no mortgage. That's great. But like when I need that money, right, I'm going to end up like, how do I get that out? Right? How do I get that out? And so whether it's even a small mortgage and keeping some liquidity and then having a comfortable payment, or whether it's unique products that allow you to essentially, buy the house with a line of credit and then pay that down. So you keep access to that liquidity with effectively paying cash. Those are like different strategies that exist now, to your point, that people can be talking about. And then, advisors can be saying, hey, we can really start exploring these options and getting that team together and saying, let's sit down together, let's explore the options, right? They've obviously trusted you with the entirety of their wealth, right? And so, your opinion should matter as well in their purchasing decisions. On that, I don't know if that answers your question.
It sure does. Yeah, it's holistic. It's an overused word. It's an abused word, quite frankly. But what holistic means to all of us, right, in our different companies, is making sure that whatever decisions we're making fit the entire puzzle and not just a piece of it. Right. Yep. That's simply said. Right. And to your point, we preach the team. Your team might not just be within one institution. It might be your private banker. It might be us as your financial planners. It might be your mortgage lender and your attorneys and your CPA. But if the team that you have chosen can come together and help you make a really educated decision, imagine how you can actually not have that buyer's remorse that a lot of people do have. And it just allows you to feel like these people have your back. It's an amazing experience for most people. Home ownership, second home ownership, vacation home ownership is an amazing, amazing way to use your life and to be able to provide for your family and keep everybody safe. I just say it's an honor for us to play a very small part in helping our clients get to the finish line, and also working with professionals like you who are really top notch doing this and don't necessarily do it the average way that our industries do it. So in addition to just being awesome for the clients that we've worked with, together, thanks for taking the time to educate our audience on just what is out there, right? We didn't get into specific products, and we did that very purposefully today, but it's a different world. It's still a really great time to purchase a home. The dynamics of purchasing a home are much different today than they were 5 years ago, than they were 10 years ago, than they were 15 years ago. So just that the knowledge that things might be a little bit different out there, not just in the marketplace, not just from an interest rate perspective, but also on a solutions perspective, is a really great thing to arm future buyers with, just so they know what's ahead of them.
Yep. I very much appreciate y'all having me. It's fantastic.
Cody, thank you. I was going to take my vest off the second this is over, but I think I'm going to leave it on the rest of the day.
I love
it. I think I'm just going to, it's vest day. We ready? Said it's sort of weird weather out there. Cody, thanks for bringing some sunshine onto the podcast. You were awesome, man. This was great. Thank you. And thank you again to all the listeners. Always appreciate you coming in on board, sharing your ears with us. Have a great rest of the day. See you on the next one.
Thanks, gentlemen.
Thank you for stopping by the Wealth on Purpose podcast. Your visit is very important to us. If you feel that you got something from your time, please consider subscribing and/or liking. For more, please visit us on granitebridgewealth.com, where a wealth of knowledge awaits.